averages tracking toward their first negative week in at least a month. This morning's the Wall Street Journal reports that Ray Dalio's hedge fund Bridgewater is using put options to bet more than $1 billion that global markets will fall by March. Sources tell the Journal's Bridgewater bearish bet is currently one of the largest against the markets, and that it'll pay off if the S&P 500, the Euro Stoxx 50, or both see a decline. Joining us now to talk more about the markets, Sarat Sethi, managing partner at Douglas C. Lane and Associates and a CNBC contributor, and CNBC senior markets commentator Mike Santoli. I was reminded of a couple of things, Mike, and that was Soros's bearish bets over the years with S&P puts that never worked out. He lost on every one of them. And then another guy who loved to deal in puts named Buffett, who didn't buy puts.
Yeah.
He sold billions of dollars worth of puts and added so much to his return based on that. Just when you sell puts, you're just betting that the market's going to continue to rise.
Sure.
So we seem to, say how high every time Dalio's on the way up, every time Dalio makes a move. I don't know what the...
I mean, the first thing to say is that the report kind of lacks context. You don't know where this position fits within the constellation of all the other things that the firm is doing. It's not a bet the firm trade on the market going down in an outright way. So I think that you have to point out. But I do think it reflects some sort of general activity among big institutions saying, puts are cheap right now. We might as well lock some in. It's been a big up year. And there is actually, if you look at some, if you can look at sort of the slope of hedging activity going out several months, there is this welling up of concern that's concentrated around early March, which is Super Tuesday, which is when somehow people think that's when election outcomes are going to be relevant for the market. So it reflects that activity, but it doesn't mean it tells you the market's going down, or for that matter, that he's going to be wrong and the market's going up.
Yeah, I mean, when puts get really cheap, obviously there's a reason, sentiment-wise, and sentiment dictates a lot of things.
It's been a calm market. We're at new highs. That puts probably should be cheap.
I mean, he's playing the odds, right? Every 18 months, you get a 10% correction on average. So
on average.
On average, right? So sometimes it happens. And for all those who've missed this 20+% rally, especially the hedge funds that are trying to say, well, we've missed most of this. So how do we get back? How do we say we're charging you 2%? I mean, there's something we've got to do. So let's bet against the market. I don't know when he's going to be right. Yeah, he'll be right at some point. But the market today has...
Yeah, you follow Bridgewater. I mean, and he has more... his hands are directly involved with some funds more than others, right? And some have done well. Some have been just miserable, right?
Well, there's the classic bond fund, which is the all-weather.
The all-weather. Which one has been...
The all-weather is the big... The all-weather is the mammoth-sized fund.
Yeah. Right.
Which over 20 years has a great record.
And which one is like... A couple of them that he was more involved with have not...
It's not that he's more involved with them or less involved with them. It's more...
But you can find some really poor performers.
But they're very model-driven, right? I mean, it's not as if it's like Cowboys saying, I'm going to be slinging...
This is not that Ray Dalio wakes up one morning and says, I want to buy Apple. That's never happening. That's not even part of the...
Then he doesn't act on his recession calls that we hype whenever he makes them. In the last few years, we've hyped a lot of his different calls, none of which have...
Right. I don't think that those calls per se...
don't reflect...
First of all, I think that we, and I'd actually put it more on us than I put it on him.
I would too.
And hyping the...
Yes, we take some time for context.
No, that's what happens. What happens
Are we doing it again today?
You also haven't done a bad...
I think
have you really gotten hurt by being long bonds? Have you really gotten hurt by thinking that yields are going to stay low around the world and there's like a lot of this macro
Very few of the big bond guys stayed long.
I think Mike's explanation is perfect, though, with the nuance of the idea that puts are cheap. This isn't a bet the firm, and you don't know what else the firm is doing to balance the risk on the other side.
And by the way, you want that. You almost want people thinking just around the corner there's something we have to worry about.
That's not new thinking over the last year either.
And it's behavioral finance 101. If we didn't have it, then we'd be off the races, and then you'd be really worried about sentiment.
Right.
So you haven't, as we've gone to new levels on the S&P, have you decided to raise some cash or no?
You know, I raise cash on specific companies that I think are overvalued. You do have sectors, stocks within the market, but I'm still bullish. I'm still invested fully. I think the parts of the market that are still cheap, the financials that are still cheap, trading below book value or at book value. I think some of the techs are extended. I think oil's getting very cheap here. So there's opportunity here within the market. But if you're fully invested, I think you stay to your objectives and you kind of, you don't have to be on the higher end. You kind of stay to the
When
mid-end.
you say fully invested, that means for everything you sell, you plow it back into something else, or do you have always a certain amount of cash that you keep?
No, I'm mid-range. So if somebody's objective is 60 to 75, I'll be at close to 65 to 70%. I'm not going to be at the higher end at this point. I think the market's kind of given us that opportunity already. But if I do have cash, I will deploy it. I'm not just going to sit on the side completely. I think there are opportunities.
Do you think the market, either one of you, that is getting desensitized to China? I'm getting bored with it, and I'm looking for the next thing to cause either.
I'm surprised the futures are higher this morning after what President Xi said yesterday.
Right. But, I mean, sooner or later, we're just going to be,
I think the market.
What's the next big? Is the election the next big?
Even within China, I think the market needs something decisive one way or the other before it reacts to it at this point. Because the premise right now is we've kind of de-escalated to a certain degree. We haven't foreclosed on the possibility of, pushing off the tariffs in December. So until we get out of that band of probabilities, the market's probably going to mostly.
What are we going to be talking about after the first of the year? Like the recession? Did we stop talking about that?
I think it's I think it's going to be
the recession. I think elections are going to be front and center for a lot of people.
You do? The national elections or everything?
Well, I think kind of who's going to be on the Democratic side, and that's probably why you're seeing all this March stuff, as you mentioned. But it's always the question of what we don't know that causes the markets to go up or down. And I think if you take on today's data, what we have, you've got a pretty good market that's a GDP of 1.5% to 2%, and stocks can do well, but it's always that uncertainty, hence the premium for stocks at this point, and bonds at 1.7. There's really not a lot of value in the bond market.
And we're going to have to test this premise that the markets are based on right now, which is that we're going to get a reacceleration. So in the next few months, you really got to see the data come around to the market's view that we've bottomed and we're off to better numbers next year.
Okay, I think after the first of the year, we've refocused too, don't we?
Well, I think earnings have to go up next year. And if they don't go up, you're going to get a market with the multiple compression coming back down.
When will we know whether they're going up? We should know by the beginning of the year.
I think this tariff thing is huge for a lot of companies with CapEx. At least when we talk to companies, they're kind of sitting on the sideline. Great balance sheet, so that's providing some bottom to the market. You're getting dividends above your 10-year, so that's providing some support to the market.
So we're showing Dalio's new market wager. Bets $1 billion stocks will fall. It's possible to have a married put to a long position too. What's the long position?
On a net basis.
What's a long position? 80 billion. So he's got a bit. How much are they managing up there?
How much is all together?
Altogether, it's a big number.
Yeah,
150 billion.
150, and how much equity in equities?
That's like a $30 or $50 billion position.
So $1 billion, and why are we? I don't know. That's like a married put, isn't it?
Well, it's one thing. It's signaling. You can see you don't know how much leverage. I mean, we just don't know what he's doing on the other side of the book. But he's not trying to beat the market year on year. His whole idea, the objectives for his clients are don't lose me money.